Hello and welcome to Economic News. For more on economics and finance, go to www.myfinancesteacher.org. Today is 4th of April 2016, and now that we finished the first quarter of 2016, we hear that according to Thomson Reuters, Chinese companies are in total the largest buyer on the global market for mergers and acquisitions. During the first quarter of 2016, Chinese companies bought nearly as much of foreign assets as they did during the whole year of 2015. Well, talk about the expanding Chinese market, you will say. However, there are some worrying factors. Firstly, most or nearly all of those acquisitions were financed by additional debt. Chinese banks are encouraged by local government to provide funds to these local companies making the acquisitions abroad. Additional financial leverage or debt, of course, adds risk to any kind of investment, especially when these debt levels, when the leverage levels are very high. And they are high for the Chinese companies. The debt to earnings ratio of the Chinese companies making the purchases, making the acquisitions is several times higher compared to the target companies that they are buying. So the existing level of debt, which is already very high, supplemented by additional debt used to finance these acquisitions, is of course quite risky. And these risks are especially dangerous if anything was to happen to the earnings of Chinese companies. And actually this brings us to the second factor that is also rather worrying. Chinese companies are making so much acquisitions abroad, and this is not accompanied by similar investments or similar acquisitions locally. Actually, according to the official government statistics in China, investments, which make up a huge portion of GDP in China, nearly half of GDP, are down. Chinese companies, instead of investing in their local market, are expatriating their capital. And the reason for that is because they expect an economic slowdown. And a slowdown that hurts earnings can be devastating to companies with large leverage, with large debts. And if Chinese companies themselves are suffering, then of course the target companies that now belong to Chinese buyers are going to suffer as well. Another interesting, rather amusing point is that since Chinese companies already have huge amounts of debt, they don't mind buying foreign companies which have rather large amounts of debt. However, from the perspective of the Western investors who are not borrowing as much to finance their purchases, from their perspective it seems that Chinese companies are paying too much for what they are buying. Now, most importantly, what are the implications for all of us as investors or potential investors? One of the implications is that huge amounts of financial leverage of Chinese companies is going to make the future economic slowdown in the country even more disastrous. Another implication is that if during the rest of the year of 2016 this capital outflow from China abroad continues, then Chinese yuan is going to lose more of its value. And even now, since the beginning of the year, Chinese yuan lost already more than 2% versus the US dollar. And this loss of value might even be exacerbated even further given the potential slowdown, economic slowdown in the future. So be careful out there with your investments and good luck.